Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how corporate social responsibility shapes smarter investment decisions. The benefits of CSR for investors. Corporate social responsibility, CSR, isn't just a moral compass for companies. It's a direct contributor to financial performance and investor confidence. When businesses focus on sustainability, ethical practices, and social impact, they create a ripple effect that benefits shareholders. Investors are increasingly drawn to companies with robust CSR programs because they promise more than fleeting returns. They offer stability, alignment with values, and broader stakeholder support. Improved long-term returns. There's growing evidence that companies prioritizing CSR often deliver stronger financial performance over time. Why? Because businesses that care about sustainability tend to be forward-thinking and adaptable. They invest in long-term strategies, reducing future risks and addressing opportunities before their competitors. Studies back this up. Research from Harvard Business School found that companies with high sustainability scores significantly outperform their peers in stock performance over the long run. MSCI Inc., a global leader in financial analytics, reports that companies with leading CSR practices show reduced stock volatility, making them a safer pick for investors. The logic is simple. Businesses focused on ethical labor, minimizing waste, and building community trust are less likely to burn bridges or money. They operate with a mindset that prioritizes resilience, ensuring solid footing through unpredictable markets. For investors, this means steady, compounded returns instead of gambling on short-term wins. Alignment with investor values. More than ever, people want their investments to reflect their beliefs. Whether it's stopping climate change, reducing inequality, or supporting inclusive workplaces, CSR-focused companies speak directly to investors' values. Think of it this way: by investing in a company with robust CSR initiatives, you're not just buying shares, you're taking a stand. This alignment isn't limited to individual investors. Institutional investors increasingly adopt environmental, social, and governance (ESG) criteria when selecting assets. These large funds are driving a shift toward responsible investing, showing that profitable decisions can align with global priorities. For an investor, this approach answers an important question: am I making a difference with my money? Companies with strong CSR initiatives allow investors to feel confident that their portfolio represents their principles while achieving financial goals. Attracting more stakeholder support. A company's value doesn't exist in a vacuum. It's built on relationships with customers, employees, and communities. CSR programs amplify these connections, leading to greater loyalty and stronger stakeholder engagement. Here's how this matters for investors. Brand loyalty. Customers are increasingly gravitating toward companies with clear social missions. When a business builds trust with its audience, it enjoys repeat sales and word-of-mouth marketing, two powerful drivers of sustainable growth. Employee engagement. A company that treats its workforce ethically and contributes to societal goals tends to attract and retain top talent. Happy employees mean higher productivity, innovation, and fewer costly turnovers. Community and public trust. Businesses that serve communities beyond mere profit generation create goodwill. Strong CSR programs reduce reputational risks, protecting companies from backlash that can damage brand equity. When a company is admired by its stakeholders, its foundation becomes stronger. This adds a layer of security for investors, knowing the business is built on trust and collaborative success rather than exploitation. For investors, CSR enhances more than just financial prospects. It presents a holistic view of a company's health. Challenges of CSR in investing. Investing with a focus on corporate social responsibility, CSR, isn't always straightforward. While aligning investments with ethical and sustainable principles sounds appealing, there are hurdles for both companies and investors. Let's break down the challenges that make CSR investing more complex than it seems. Greenwashing and misinformation. Not every company advertising its commitment to CSR is genuinely practicing it. Greenwashing, when businesses exaggerate or mislead about their environmental or social efforts, has become a persistent problem. For instance, a company might highlight its eco-friendly initiatives while ignoring harmful supply chain practices. Products labeled as sustainable may carry hidden trade-offs that contradict those claims. These tactics create a false sense of responsibility and make it difficult for investors to identify businesses genuinely living up to their promises. Why does this matter to investors? Eroded trust. Greenwashing damages trust, making it harder for investors to believe in a company's claims. Financial risks. When greenwashing is exposed, it can lead to lawsuits, public backlash, and stock price drops. Wasted capital. Investors aiming to support CSR end up funding companies that don't align with their values. The challenge for investors lies in separating fact from fiction. Transparency in CSR practices isn't standardized, leaving room for companies to conceal weaknesses. Without digging deep, ethical investing becomes a gamble, not a strategy. Balancing profit and purpose. Here's the hard truth. Businesses exist to make money. While CSR is seen as a long-term value driver, the short-term pressures for profit can clash with social responsibility goals. Shareholder expectations. Investors often demand quick returns, creating pressure for companies to cut costs or increase margins in ways that may conflict with CSR principles. Higher costs. Ethical practices, like paying fair wages or sourcing sustainable materials, often come with higher upfront expenses. Implementing CSR initiatives can challenge profitability, especially for smaller businesses. Think of it as trying to walk a tightrope. You want to move forward without losing balance. For companies, the balance is between satisfying shareholders and sticking to ethical commitments. For investors, the tension raises doubts. Is this company truly committed to CSR, or will it sacrifice purpose for profit during tough times? This conflict often creates an either-or scenario. Some companies go all in on profits, sidelining CSR, while others overcommit to responsibility but struggle with growth. Investors face the challenge of finding businesses that can deliver both. Lack of standardized metrics. One of the biggest obstacles in CSR investing is the lack of consistent ways to evaluate success. Unlike financial reporting, CSR and environmental, social, and governance (ESG) metrics aren't universally standardized. Each company might report on different metrics, use varying methodologies, or leave out vital details entirely. Here's how this lack of clarity causes trouble. Inconsistent data. One company might highlight reduced carbon emissions, while another focuses on workforce diversity. Without comparing apples to apples, it's hard for investors to know which companies are truly performing well. Subjectivity. What counts as good CSR can vary. Some investors may prioritize environmental impact, while others care more about social programs. The absence of universal benchmarks makes it tough to measure performance objectively. Time gaps. CSR reporting often looks backward, lagging behind real-time investment decisions. Investors may not know current performance, relying on outdated data instead. For example, imagine an investor trying to compare a multinational conglomerate with a clean energy startup. If both report CSR metrics on different scales or fail to disclose key details, it's like trying to solve a puzzle with missing pieces. This lack of standardization can lead to confusion, reduced confidence, and missed opportunities. While tools like ESG scores are a step in the right direction, they're far from foolproof. Investors must rely on their own research, which is time-consuming and doesn't guarantee accuracy. CSR-focused investing has enormous potential, but the barriers are real. Greenwashing, misaligned priorities, and non-standardized metrics make it more challenging for investors to feel confident about choosing truly responsible companies. Understanding these hurdles is essential before committing to CSR-driven investments. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.